The overall IRS audit rate is 0.49%. For Schedule C filers, sole proprietors, and single-member LLC owners, it is closer to 1.4%. For Schedule C filers reporting gross receipts above $100,000, it climbs toward 2.5%. That sounds manageable until you realize that an audit doesn't just evaluate the item that triggered it. An auditor reviews your entire return and typically examines 2 to 3 prior years as well. A $4,000 business meals deduction questioned in an audit can open a $28,000 examination across 3 years. Know what draws scrutiny. Document everything as if an auditor will see it, because one might. The IRS uses a discriminant function system, DIF Score, to compare your return against statistical norms for your income level and industry. Deductions that are significantly higher than the norm for your business type flag your return for human review. The IRS publishes no official list of the DIF triggers, but decades of audit experience and tax court cases reveal the consistent patterns: high business meal deductions relative to revenue, home office claims on sole proprietor returns, vehicle use claimed at 100% business, large charitable deductions relative to income, and Schedule C losses reported year after year without profit. Reporting a net loss on Schedule C for 3 or more consecutive years is one of the most consistent audit triggers. Under the hobby loss rules of IRC, Section 1083, the IRS presumes a business is a hobby if it fails to produce a profit in 3 out of 5 consecutive years, with a 2 out of 7 year standard for horse breeding and racing. A hobby cannot generate deductible losses. If audited, you must demonstrate that you conducted the activity with a genuine profit motive through professional practices, business records, marketing efforts, and actual evidence of intent to make money. Consecutive losses without documentation of business activity are indefensible. Vehicle deductions are among the most heavily scrutinized items on a small business return. Claiming 100% business use of a vehicle, particularly a personal vehicle, is a red flag because the IRS knows that most vehicles have some personal use. The substantiation requirement under IRC Section 274 is specific: a contemporaneous mileage log recording the date, destination, business purpose, and mileage for every business trip. Reconstructed logs created at year-end are not considered contemporaneous and are routinely rejected in audit. Use MileIQ, Everlance, or a notebook in your car. Log every trip as it happens. Business meals, deductions under IRC. Section 2474 require: the meal was directly related to business. Both parties' names and business relationship are documented. The business discussion that occurred is noted, and a receipt is retained for any meal over $75. The TCJA eliminated the 50% deduction for entertainment expenses, sporting events, concerts, golf, but retained the 50% deduction for business meals when work is discussed. Meals where you eat alone are generally not deductible. Meals with business contacts are 50% deductible with documentation. Meals that serve no discernible business purpose are not deductible at all, regardless of how they're categorized. Cash-heavy businesses, contractors, restaurants, salons, auto repair attract disproportionate audit attention because the IRS knows cash is difficult to trace. A business with $200,000 in gross revenue and $40,000 in reported cash sales that reconciles poorly with bank deposits will draw scrutiny. The IRS uses statistical models to estimate what a business of your type and size should deposit annually. If your deposits significantly exceed your reported gross receipts, or if receipts significantly exceed deposits, the discrepancy becomes the starting point of an audit. Accurate bank deposit reconciliation is your first line of defense. The documentation standard for surviving an audit is not complicated, it is consistent. For every deduction you claim, retain the receipt, record the business purpose at the time of purchase, and file it in a system you can retrieve in 18 months. The IRS typically has 3 years from the filing date to audit a return, 6 years if they suspect income was understated by more than 25%. Digital systems, a dedicated folder in Google Drive or Dropbox with receipts sorted by month and category, are admissible in audit and significantly faster to produce than a box of paper receipts. Inconsistent income reporting is a straightforward trigger. The IRS cross-references every 1099 NEC and 1099K you receive against what you reported as income. If your reported gross receipts are $85,000 and the IRS received 1099s totaling $97,000 for you, the $12,000 discrepancy triggers a CP 2000 notice, an automated underreporting inquiry that is not technically an audit but functions like one. Report all income, including cash, Venmo, and amounts paid without a 1099, and reconcile it with the 1099s you expect to receive. Discrepancies always resolve in the IRS's favor unless you provide documentation explaining the difference. If you are audited, 3 rules apply universally. First, respond to every IRS notice within the stated deadline. Silence is treated as agreement with the IRS's proposed adjustment. Second, provide only what is requested. Do not volunteer documents or information the auditor hasn't asked for. Third, if the audit involves more than a simple document request, hire a CPI or tax attorney to represent you. An enrolled agent or CPI with audit experience can communicate directly with the IRS on your behalf and knows what is and is not appropriate to provide. Representing yourself in a complex audit is almost always the most expensive decision. The best audit outcome is never having to think about it, because your documentation is complete, your deductions are legitimate, and your return accurately reflects your income. 3 consecutive losses, high business meals relative to revenue, 100% vehicle use, and income that doesn't match your 1099s. These are the patterns that pull returns into review. Document contemporaneously, file accurately, retain records for 6 years. For a comprehensive look at how the IRS audit process actually works, if you're selected, the IRS audit process video covers every stage from initial notice to resolution.